Okay, sounds good. Well, we had the June industrial production numbers come out at 9:15 this morning, just before the market opened, and they were exactly as the market was expecting. They rose 0.6%. June capacity utilization actually was a little bit less than expected, 78.0% versus 78.3% expected. And then at 10 o'clock after the market was open, the July housing market index came in as expected at 68. So that was the economic news that the Treasury market was trying to digest. And as you can see, we still continue to meander here just beneath this 20-day moving average. We keep battling up against it, and I suppose that will make it much more meaningful if and when we do finally rise back above it. But at least for now, we are sitting just beneath it and looking to see if we can get that breakout. I did want to mention, before I get into Netflix and some of the other stories today, that if you look at, or if you saw the blog this morning, I did post under historical tendencies not next week, starting tomorrow, or really today at the close, the next week is one of the worst historical weeks of the year. It doesn't mean that we're going to go crashing or anything like that. I don't want to, give that kind of an indication, because that certainly would not be, that's not likely to happen. But there is a historical tendency for this upcoming week to be bearish. This is the time of the calendar month, which tends to be pretty weak in just about every month, with December being an exception. So it's not unusual to see the market pull back as we get into the third or fourth week. You get into that option expiration time frame, and that tends to put a lid on the market. But I did want to point out here the major indices, these three indices, the S&P 500, the NASDAQ, and the Russell 2000, going back on the S&P since 1950. So we're talking about 68 years, almost 7 decades. This upcoming week, July 18th to July 24th, has produced an annualized return of minus 22.93%. That would relate, or you could compare that to, say, the S&P 500's average annual return of about 9% over that same period. So it's down about 32 basis points, or 32 percentage points, from what it normally does throughout the year during this upcoming week. And I think that's noteworthy. The NASDAQ since 1971 has had an annualized return of minus 41.76%. And then you've got the Russell 2000 since 1987. That's been down an annualized 48.88%. So these numbers are not very good. It just tells us that the tendency is for the market to pull back. There is no guarantee. I do think the market still looks pretty good technically, but I did want to pass along the historical indications, because outside of the third or maybe fourth week of October, there really isn't a week as bad as the one that starts today at the close. So I wanted to make sure everyone was at least aware of that. Now let's take a look at some charts, and the first one has got to be Netflix. I wrote about this one in my blog this morning because I thought Netflix, and you alluded to this as well, Erin, yesterday on Netflix, that it just seemed like it was perhaps poised for some more downside action. And if I look at first of all, there was a negative divergence on the PPO. And you might look at it at first and say, well, doesn't look like one, because technically you have to have higher prices with a lower PPO. Well, the PPO is clearly lower. But if you look at this at first, you might say, well, that doesn't look like it's as low. Here are the highs 420, and it looks like over here we went up above 420. But I want you to realize that the PPO, the MACD, the PMO, all of these momentum oscillators are based on closing prices, not on intraday, not on opens. So one of the secrets that I always talk about in terms of the MACD or the PPO is that you want to be careful when you're looking at negative divergences or positive divergences using candlesticks. I think it's much clearer if you use a line chart. And I don't advocate using line charts very often. But here you can see that clearly on a closing basis, that's the advantage of a line chart, is it only shows you the closing price. So it gets rid of all that noise in a candlestick that might give you an optical illusion. But here you can see the closing prices on Netflix. It absolutely moved higher. The PPO was lower. That is a negative divergence. And what I look for is then the 20-day moving average no longer holding and possibly seeing a 50-period test. And if you go back and you look at the highs that were made back in late January and early March, higher prices, lower PPO, That's exactly what we did. We went down to the 50-period moving average, and then we started to resume that uptrend again. So the short-term chart was already showing perhaps we were going to have some issues with Netflix. And the weekly chart, if you look at today's low, it went right down to the 20-week moving average and then bounced back up. That was the first test of the 20-week moving average in 2018. So Netflix, from a technical perspective, I would not write the stock off at this point. We might see some additional consolidation at that 20-week moving average, maybe a little above. But I think that, what you said earlier, Erin, I think that Netflix selling off like this was more of a trading opportunity than anything else. And those who maybe have been sitting on the sidelines, that certainly provided an opportunity much cheaper. I think the low today was 344, and just recently we were at 420. That is almost $80. It's probably about 17, 18% off of the high that we saw. So Netflix has pulled back quite a bit. I would not be surprised to see it consolidate a little bit and then move higher. All right. Boeing was in the news. Boeing, they raised their long-term forecast for commercial airplanes by 4.1% to 42,730 new jets over the next 20 years, which is a little bit more than 2,000 new jets per year. And this is valued at roughly $6.3 trillion. They went on to say that Boeing's annual forecast has been renamed the Commercial Market Outlook, the CMO, and it is something that is going to be updated on an annual basis and is probably the leading indicator in terms of what to expect in the airline group and in aerospace going forward. But anyway, you can see Boeing did rally at the open on the news. Volume is just kind of so-so. It's pulled back, but I do like the fact that we've moved back up through our moving averages. And on any weakness, I would look for those moving averages to see if they hold. If they don't, then I think you got to step back to that weekly chart on Boeing and recognize what we talked about, I think, yesterday, that we could be in for some sideways action for a while. So in the short term, let's watch that rising 20-day moving average. If that fails to hold, then I would consider this consolidation that we've seen so far throughout 2018. I would expect that to continue. A couple of companies came out and raised their guidance, but two of them announced secondary offerings with the raise in guidance, which I don't know. I think maybe they probably could have waited and perhaps gotten a better response. One was Carbonite, CARB. They raised their Q2 revenues and EPS above consensus. Then they went on to raise their full year guidance. Unfortunately, they also announced that they are going to have a 4 million share secondary offering. And so that kind of dilutes things. And usually when you announce an additional offering, the stock goes down. So I think they kind of wasted their good news by saying that they were going to be beating on top and bottom line, and that they were raising their fiscal year guidance and so forth, because the market seemed to have overlooked that and just kind of focused on the fact that there was going to be a secondary offering. Another company that also raised guidance and then announced a secondary offering was NSTG. You can see the stock gap down on the news, took off intraday, and now is all the way back down near the low again. So it's been very volatile. And this is a stock actually doesn't have a whole lot of volume on a normal, regular basis. So I'm not sure it's one that I would trade anyway. But I did want to just point out the volatility that comes along with both sides of the news equation. We got the good news with the raised guidance, and then we got NSTG proposing a $50 million secondary offering. I'm not sure of their market cap, so I'm not sure how much $50 million is, but apparently it's enough to spook traders with the stock down 7.3% today. And then the last one, ECPG. This is, I believe, in the might be consumer finance space. They issued upside revenue and EPS guidance. Stock gapped up and then sold off hard, went down close to its recent low, and has now rallied back up. You can see the volume very heavy today. I wanted to show you a relative chart of this stock because for whatever reason, even though they raised guidance, the market doesn't seem to like Encore Capital Group. After topping back here in November, we have been putting in lower lows and lower highs on ECPG. And in the consumer finance space, the group has been going higher. So what that means is we have a company that has been wildly underperforming its peers and also underperforming the benchmark S&P 500, even though its peers have been outperforming the S&P 500. So it's almost as if the market said, well, kind of shrugged off the raising of guidance in a company that the market really is not favoring at this point. So if we could get back up maybe through $39, which seems to be pretty key price resistance, and that declining 50-day moving average, maybe we'll start to see some outperformance on ECPG. But for now, anyway, I'd be really careful with the stock. Even with raised guidance, the stock up less than 1%. Kind of makes you scratch your head sometimes. Anyhow, let's take a look at some other charts. UNH, UnitedHealth Group, or UnitedHealth Group. The stock did respond negatively. They came up just a tad short on revenues, $56.09 billion. Market looking for $56.1 billion. But they beat on their bottom line, $314 versus $303. And this is a company that has been performing well in a good group. So here's the healthcare or health provider index, which is what just recently, a few days ago, broke out to a new high. And you can see that United Health had done the same thing, breaking out to a new high. And this is a stock that's been leading the healthcare providers index higher. Now, we are showing a little bit of weakness here on a relative basis in the near term, but I actually think this 50-day test and maybe this trend line support test is a good entry point on UNH. Not quite the performer that we've seen out of Netflix, but UNH has been a very solid performer, and especially given the fact that it's a large company and it's been able to move higher with all of the headwinds that the large caps have faced in 2018. I think this is a pretty nice performing stock, and the pullback certainly could be presenting a nice opportunity into United Health. Johnson & Johnson, we talked about this one yesterday on the show. I know Erin really liked the way this one was setting up, and they did come through and they beat on top and bottom line. $20.83 billion in revenue, the market looking for $20.39 billion. Bottom line, $2.10 versus $2.06 expected. And we are seeing J&J bouncing to its highest level, gapping up to its highest level since back in mid-April. So good news here. The problem I have with Johnson & Johnson is just that on a relative basis, maybe this will begin to change things, but on a relative basis until today, this was a stock that was really reeling to the downside relative to its peers and also relative to the S&P 500. But perhaps this gap up, maybe we'll have a strong finish, get this nice little breakaway gap from the downtrend, and perhaps begin to establish an uptrend, something to watch on J&J. Goldman Sachs, let's pull this one up on a relative chart as well. Goldman Sachs beat by a mile on the top line, beat by a mile on the bottom line. $9.4 billion in revenue, market only expecting $8.71 billion. And then bottom line, market looking for $4.67. Goldman Sachs posted $5.98. Significant beat on both top and bottom line. And you can see the market really doesn't care. Goldman Sachs down $3, $2.28, with the market moving higher. You can see that investment services, they've kind of topped and rolled over, but even worse, I think that Goldman Sachs looks like it's gone down quite a bit more. And when you look at their relative strength, that's exactly what this is telling me. So even with a big beat top line, big beat bottom line, they're rolling over again relative to their peers. Something's not right here with Goldman Sachs, and this is a company that I would continue to avoid. Now, perhaps later today, maybe we'll get this huge rally and the stock will finish back up over 235, 236, maybe start to begin to look a little bit better on a technical basis. But I would not be buying it based on the fundamental news. I'd have to see that technical development turn bullish as well. And then the last one I wanted to mention here is OMC. This is Omnicom. They missed on their top line, beat on their bottom line. They missed on the top line, $3.86 billion versus $3.89 billion. And then bottom line, they beat $1.60, $1.60. Market looking for $1.54. I didn't see guidance. I'm not sure if they lowered guidance, but clearly the market didn't like it. It's down 7.7%. And on a relative, this is in the media agencies group, by the way, and this group is really getting hit today after looking like we were ready to make that big breakout on a weekly chart. Some of the smaller stocks, I think, are still doing okay in this space. Larger ones, though, getting hit pretty hard. And you can see with the action today, OMC, relative to its peers, now breaking down to about a 6-month, 7-month low. So OMC not looking very good here. Heavy volume, breaking below its moving averages, not looking very sharp. Okay, Erin, I know you've got 2.0 of your chart pattern, so I'm going to let you take it away.
Absolutely. Let's go ahead and get started here. I'm going to talk to you today mostly about bearish chart patterns. We pretty much covered all the bullish chart patterns in my last workshop, so I want to concentrate more on the bearish patterns. And if you didn't see the trading chart patterns part 1, you can find that in the July 3rd Market Watchers Live program. That's when I did the workshop originally. So if you want to take a peek at how to trade the bullish chart patterns, go right ahead. I'm going to show you how to trade bearish chart patterns, but I'll be perfectly honest with you that I generally don't short the market, especially in a bull market. So I do want to show you how these work as far as shorting particular stocks, but I just want to preface by saying that I generally don't do that. But I think these patterns are, perfectly valid to short the market or to short that stock against the market. So let's go ahead and we're going to start. And I'm going to look at, like I said, the bearish chart pattern. So I'm going to start first with a bear flag. And these are actually the chart patterns I did in my introduction to chart patterns. And I believe that's on YouTube if you look that one up, but I did that quite a while ago. And these charts are pretty much from that. And then I'm going to try and show you some active chart patterns that are going on right now in some of the stocks. So let's go ahead. We're going to start with the bear flag. All right. So I think most of you are familiar when you look at a bear flag, what it looks like, but it's basically an inverted or reverse flag. That's also what it's called, a bear flag or a reverse flag formation. And these are continuation patterns, meaning that you're going to take that big dip down the flagpole and then you're going to start consolidating, and that will form the flag or the pennant, depending on how it shapes up. And so that downtrend is expected to continue. So what you want to do, and this is what's so great about trading chart patterns, is that by measuring the height of these patterns, you can set up your targets when you're trading. And that makes things a lot easier than just sort of eyeballing it and trying to decide where might be a good place to set a target and where might be a good place to set a stop. So let's go ahead and look at this one a little more closely. I'm going to annotate it as we go. All right. In fact, I think I'm going to go ahead and I'm going to take those annotations off so we can just start from the beginning here. All right. Actually, now let's leave that. Okay, so I'm going to show you there's that reverse flag that we're looking at. And with flag formations, the height of the pattern added to the top or the breakout point from the flag gives you the minimum downside target for a reverse flag. Okay, so we're looking, as far as bearish formations go, we're looking for minimum downside targets. Because obviously, if you're looking at a bearish pattern, your expectation is going to be that it's going to fall and go down. So what I would do is I measure the pattern, don't really pay attention to those percentages. I'm mainly interested when I do this in just the height. So I'm going to grab this and you can see you can move it around. And once you get that lined up, then you can just, in fact, I'm going to take this one out. All right, and so all you do is copy this one, and that depending on what computer you are using, but if you hold down I believe the control or the command key, if you're on an Apple, just hold that down and then it'll create a duplicate for you. And then you can just add that onto the bottom. And that gives you your minimum downside target. So the question is, of course, well, where do you set your stop? And a stop, of course, when you're shorting is going to be higher. So how much can you take as far as the short to the upside? Well, I find with bear flags, typically you can just use where that flag is ending or topping here. Like we can see here, it tops out right about here at 82.50. So in this case, I would set my stop. I'm going to just draw a horizontal line right up here at about 82.50. And we know my downside target is all the way down here at, well, it looks like $76. So the reward to risk that's set up here is quite nice. And that's what you really want to look for when you're doing these chart patterns, is figuring out, you know, how much risk you're going to take on the loss right here, of course, and then what your reward will be is if you hit your target. So this would be your setup for a bear flag and how you would do that. So let's go, and I want to go show you a more up-to-date one so we can look at something that's happening right now. And here is Ford Motor Company, and I found a reverse flag here. So let's go ahead and annotate it and see how we would measure our upside and downside targets. So right here, you can see there's your percent change. All right, and we're going to make this the height of the pattern. So let's get right on in here. So that would be the height of the pattern. And now we want to see where our minimum downside target will be. So I'm going to, like I said, hold down that control key or command key and line that up. And this gives me my minimum downside target. Well, clearly it's lower than this previous support. I would probably go ahead and just set my stop or my minimum downside target around $10. Yes, you could go with a target that is more, but I think I would set it right here and then set up a recheck is what I call it. I kind of, when I'm trading, I tend to check, you know, what I'm doing as it's going. And if I hit an intermediate stop or target that I've set up, that's my clue to go recheck it and make sure it's doing what it's supposed to be doing. So right now we can see this flag is executed. Our minimum downside target is way down here at, oh my goodness, well, we could probably say that's at $9 possibly. So you can set that as your minimum downside target, but where do we set the stop? And like I said, we want to look at maybe the top of that flag formation. Or in this case, we can see it even lines up in the thumbnail with the 200-day EMA. So there's another thought as to why you might set your stop here on your short trade. And then, you know, really while you're watching the pattern, if you keep track of your, you know, your investments, it doesn't have to be daily, but if you keep track of them and you watch the PMO, it can also give you some hints as to whether it's going the right direction. And I can see that we've already had that breakdown from that flag, and the PMO is accelerating and still moving lower and is not oversold. So in this case, I would expect, you know, to reach this downside target, or at least at the $10 range. So I would probably set my stop right up there around 11.25 or the 200-day EMA. And then that gives me my risk right here. But look at the reward is quite good here. So let's go ahead and we're going to look at the next pattern. And that one is going to be a rising wedge or an ascending wedge. And this can be kind of confusing for people because it's rising. So the thought is, you know, if you're seeing a rising pattern, you should expect a continuation of the upside movement. But that's not correct. So intuitively, it kind of makes sense that, you know, you have a rising trend channel, and that's one thing. But if you get the wedge where you can see the rising bottoms starts to go up and the tops, when you connect them, you end up getting a pattern that you're not looking at parallel lines like you do for a rising trend channel. You're starting to see that squeeze at the end of the pattern. So how do we determine our upside and downside targets? Well, let's get in here and annotate. All right. Now, with wedges, it's sometimes not clear as to how you do your measurements. And I will admit to the fact that these measurements of some of these chart patterns are not necessarily textbook. Not everybody in the books that I've read, in the textbooks, necessarily use these ways of measuring patterns, but I have seen them measured the way I'm going to show you. So it's something that you can, I think, use as far as setting up those targets and stops. So right now, the height of this pattern, you go back to the last top and bottom, and that's where you measure. So right here, we can see that that's about the height of this pattern. And we want to measure it. I'm going to drag it over here from the breakdown point from the wedge. Okay. And so that tells you, if you get the breakdown, how far you should expect it to fall. Now, I would say when I looked at if I were to look at this pattern, I could see that that would line up pretty much with this support at the bottom of this wedge. I would probably go a little bit further on my target, because the other thing you can do, of course, is to look for major support and resistance, and that can also help you with setting your targets and your stops as well. But I wanted to give you an idea of how you can measure the patterns and then look for the size of that breakdown. So in this case, this is a pretty small rising wedge, and it's not really giving us that much information as far as the height and where it's going to go as far as a target. I mean, 2.82% is not something I would be looking at as a possible trade. But I'm going to drag this out. You can see that it does match up quite well, the downside target here with previous overhead resistance, now support. So it matches pretty well there. And again, though, I would be looking for a better risk reward, right? You really want to see more on what you can do here. So I would look for the fact that, okay, we do have a bearish formation, but I would start to pay attention to where my EMAs are, what the PMO is doing, and that could give you some help as well as to whether the chart pattern is really viable and, tradable. So I'm going to show you also where we might find some support and resistance that would help you with this trade as well. Now I'm going back here and I'm looking at the tops that we had back in, earlier in that year. And that, I think, lines up with some interesting target. And you can see we actually would have hit that target down here off of that decline. So these are the things you're going to be looking for when you're talking about an ascending wedge. But let's go ahead and look at one that I think is forming or has formed. Let's see, which one was I looking at? Yes, it is forming, and it has executed now. Something to keep in mind as well when you're looking at chart patterns, that you can see them forming, but you really can't call it that chart pattern until it executes. But you can watch them and you can see how they're forming and pay attention to that. But textbook is that you can't truly call it that pattern until it executes. But obviously, when you see the bloggers here writing, you're going to find that we, of course, are going to call out what pattern is forming or shaping up. So in this case, we had a rising wedge. We're getting the execution of this pattern just right to T here. Let's go ahead and measure and see where our minimum downside target should be. And remember the word minimum. That means this is the minimum we expect it to fall. And it means that it could fall further. Look at this PMO too. I mean, this is really set up as a nice short trade. So let's get the measurement of this pattern on the back side. And I'm going to now click on it and copy it. Again, holding down my command key for an apple. All right, so we actually haven't even hit that minimum downside target yet. I'm looking at this pattern. I think you could even look and see, let's see. Yeah, I don't see a ascending. We just have the ascending wedge here, so I'm not going to get ahead of myself. So here is our minimum downside target. Let's see if that lines up with any support and resistance we already have out there. And we can see it does line up with a few areas of support. So I think this is a viable minimum downside target. And if you wanted to get even, take it to a lower level, I think you could even come all the way down here, maybe set another downside target. But at a minimum, we're supposed to expect it to move down to 154. And so that's what we should be watching for here on Snap-on Incorporated, SNA. So, I mean, this is a trade that if you wanted to get out there and get started on as far as a short, you're welcome to do so. I would just warn that, again, I believe we are in a bull market configuration. As far as decision point is concerned, we are in a bull market configuration. We have the 20-day EMA above the 50 right now and the 50-day above the 200. So I'm looking at a market in general that is rising. So I'm not going to be trying to pick out shorts because, let's face it, in a rising market, it's rising for a reason. All of the stocks in those indexes are mostly going up. So why try and pick out those one or two that are very, very weak? All right, somebody did ask how subjective my choice of determining the flag pattern, how subjective. All of these patterns, I would say, are in the eyes of the beholder. I think it is sort of a subjective, creative thing to do when you're looking at, you have to use your imagination a little bit as to what you might be seeing. I'm looking at this and I can see a possible, you've got a rounded bottom here and a pullback on a handle. So that would tell me if this had just started to form, that I should expect an upside move, the size of this pattern. And I would guess if I were to line this up, that we would end up having reached it all the way when we got up to here. So these are ways for you to follow along these patterns. But yes, they are rather subjective, eye of the beholder. I might see a certain pattern and somebody else might see a different one, which is why it's a good idea to check, read up on some of the books. Bulkowski has written some of the best books on Thomas Bulkowski on chart patterns. He has a huge one called The Encyclopedia of Chart Patterns, and it covers chart patterns you've never heard of. I mean, there's all different kinds that he's found and has tested, and it gives you a really good picture of those. And then for the basic chart patterns, like I have been discussing in these trading workshops, the visual guide to chart patterns that Bulkowski wrote is another one that I would recommend. All right, so we've looked at the ascending wedge, and we're looking at one that's actually in the throes of executing. So let's go ahead. The unfortunate thing here, right, is that it ended up taking that very deep dive, and it took up almost all of that minimum downside target, threshold and range, which is unfortunate. But I think when you're looking at a breakdown to this degree, and then you can see these interesting support and resistance levels, there's, again, you can set this up and still be looking at a pretty good downside target. All right, so let's next look at a descending triangle. All right. A descending triangle is a continuation or a reversal pattern, meaning that you don't have to, a reversal pattern means you would have to go up into it if it was a bearish pattern, like a head and shoulders. And it would, you'd have to go down into it for a reverse head and shoulders that would be a bullish pattern. So the idea is these can show up. You can go down into them, you can come up into them. It doesn't matter because they can be continuation or reversals. So what you're looking for is a declining tops trend line and a horizontal below it, horizontal support below it. So let's go ahead again. I'm going to take this, we're going to annotate it and see how you would make those measurements to set up your stops and your targets. And again, these are the price percentage change. So, and I don't always, again, pay attention to those percentages. I'm using this to take a fairly accurate measurement. So this would be the size of this pattern. Again, the last place it touched on that horizontal and the top that it touched right after that. So that would be your measurement. So now we've measured the pattern, and we know that if you break down, your expected minimum downside target is going to be the height of the pattern added to the breakdown point. Oops, that one didn't work. There we go. So I'm just going to line it up here. And I can, of course, drag it out if I want and get a better picture or view. So we had this descending triangle. It activated back here when it slipped below 200. And the minimum downside target was set down here at about 182.50. Again, minimum downside target. Where would you set your stop here? It might not be so clear. You know, we have the height of the pattern. Well, I don't want to make it the height of the pattern, my stop, because then I'm ending up with a one-on-one risk reward here. And I would like to see something better than that. So what I suggest when you can't necessarily tell and there's not really any references to go by, you know, in the past that you can see, what I recommend is taking halfway through the pattern. And this is my own device. This is my own thing that I've thought of. Take it or leave it. But I think it's helpful as far as setting those targets and the stops. So let's say this is about halfway through that pattern. So now I'm going to set my stop right there around 205, 206. And now I have a 2-to-1 risk reward just set up just simply because I took half of the pattern to set up my stop. So you can use this, of course, I showed how to do this in that original trading chart patterns workshop. And now you can see it right here. And I'll go ahead and save these. Let's look at one that maybe is in the process of working or has worked. All right, the Van Eck Vectors Russia ETF. I'm seeing a descending triangle here shaping up. Remember, bearish pattern. Let's go ahead and measure and see what our minimum downside target would be and select a possible stop. All right, so here is the measure. Whoops, let's go ahead and get the right tool. There we go. All right, so I'm going to use this to measure the height of the pattern. Again, the top and bottom of the last formation at the beginning of that particular formation, that ascending or descending triangle. So we want that height based on the first touch of the support line and the highest of the pattern at the beginning that was forming this ascending triangle. So this is what our the height of the pattern is. So now I need to copy it down and give me my minimum downside target here. All right, so my minimum downside target is about 20.50. Does this match up? Let's see if it matches up with any support or resistance that's already out there. It does match up somewhat here to these to the bottoms we've seen here in late June and early May. So I think this is a valid target. Now again, where would I set my stop? I think it's pretty obvious because I can see these tops here and it does tend to hit about halfway through this pattern. So I think, like I said, to get just that minimum 2-to-1 risk reward, that would be a possibility to set it up. And in this case, we were fortunate enough to have an area of support and or resistance to look at as setting our stop for this short sale. And of course, you can make this just your intermediate look, because let's face it, down here is where you've got some very strong support as well. You could very well see your target, move lower on this, but this would be your minimum downside target. This is what you should expect to see. Now, I will say, and if you've followed chart patterns, and I think the majority of you do use them, we'll take a look at that in just a moment. If you do use chart patterns, it is helpful still to use your other indicators, because a lot of times, even though it's considered the minimum upside or minimum downside target, you're not necessarily going to hit them. So just be aware and watch carefully. All right, let's look at some double and triple tops. I'm going to show you the original here real quick, because these are already activated. So I want you to see some that have actually activated. So this would be a bearish double top. And honestly, I think you could make a case for a triple top here if you considered this. But typically, those double and triple tops, you want to look at similarly height, similar in height for the top of the M for your double top, or the top of the, where you're getting the triple top here. That's another, you kind of want it to be a little bit higher just to be technically solid, I guess is the best way to put it. Okay, so we would have set our target here, our height of the pattern here. So there we added right now to get that minimum downside target, and we hit it on that decline. But let's see if once we'd hit that target, where might we have gone from there? All right. There is more downside target move down here to this area of support. So that's a pretty good setup. Where would we have set our stop on this pattern? I would have looked back to see previous support and or resistance. And I think that would be a pretty good area to set your stop on a short sale here. All right. And let's see, I think I have one that's in motion here. Okay, these two had already executed, so I just wanted to show you. I wanted to find one that's in action right now, but it's not always easy to find those patterns when you want them. All right, so let's look at the very last one, which will be the head and shoulders, and then we will clean this up and summarize and give you some takeaways. All right, I think this is probably one of the most recognizable patterns that people see. And of course, it looks like a head and sitting on two shoulders. They have reverse head and shoulders. This is your regular head and shoulders, I guess regular you could call it. All of these patterns are reversals, so you need to see it coming up into that head and shoulders to be a true head and shoulders. And again, it doesn't become a head and shoulders until it actually executes. So it wasn't until back here when we had that drop where this pattern actually became a head and shoulders. But again, here's the height of the pattern. This is where you would set your target on the downside. Remember, height of the pattern and added. And then let's go ahead and look, like I said, and see if it lines up with any interesting support and resistance. You'll find it is quite interesting because you do end up lining up with some support and resistance many times. So right here, I'm seeing this bottom we got and this top, and that's your minimum downside target. Well, that makes sense. Maybe I might set it up here. Well, we didn't know that. I can't say we would have set it up there because that happened after it executed. All right, hindsight is 20/20 after all. So we didn't quite hit the target before starting back up. So, that would have been, you might want to reset your stops, as it goes, as you're watching them, because watching what's going on with the PMO can be very helpful. And you can see it was starting to turn up back here. All right, I am going to let that one go, and I'm going to just see very quickly if I have one that is in play. And yes, this one is in play. I'd say now that it's starting to reach that neckline as resistance, so I would be very cautious. I think if you measured this, you can see we just about hit that minimum downside target. And, so this one, I don't think I would be getting into, at this point. If you wanted to play it because it's going to reach the neckline and hopefully turn down, you could, but look at the PMO. Why would you do that? All right, so let's go ahead and summarize what we took a peek at. All right, so these are the bullish chart patterns that I did cover in the trading chart patterns. Again, it's Market Watchers live program July 3rd, just 2 weeks ago. So you can go look at the bullish chart patterns and how to trade them. But what today we looked at were those bearish chart patterns, and you'll see those on the next slide. All right, there are bearish chart patterns that we covered today. And then finally, I wanted to show you the takeaways that I want you to think about when you're getting ready to trade those chart patterns. Of course, pattern recognition. So if you're having trouble recognizing the main chart patterns, practice that first. Pattern measurements are the height of those patterns. For triangles, you look at the first top of the pattern and the first bottom of the pattern, and that gives you the height. Then you can use that to get your minimum downside targets. And then you can set your stops and your targets by using nearby support and resistance. Or if you're not so sure, you can use half the height of the pattern as your stop. So that pretty much completes it. Let's go ahead and look at the poll that we're talking about today, chart patterns. I'm curious to see if all of our viewers use them. Yes, 80% of you use them when you're trading. I don't know why you wouldn't really, unless you're just not familiar with those patterns. But I really highly recommend you get familiar with these patterns because they really can take the guesswork out of setting your targets and your stops. I love trading chart patterns. I'm chart pattern crazy. As I think I wrote an article a while back that I am truly chart pattern crazy. I love looking at the textbook style ones, but I also follow some of the ones that are in Thomas Bulkowski's Encyclopedia of Chart Patterns. So how about you, Tom? Do you regularly use chart patterns when you're trading?
Oh yeah, I love using patterns. I'm more of a continuation pattern kind of a trader. So especially when we're in a bull market, I like to look for continuation patterns, whether it be inverse head and shoulder, ascending triangle, maybe I mean a cup.
Yes.
A lot of different continuation patterns out there, but those are some of my favorites. But yeah, I if I spot a pattern, I really pay attention. And for me, I like to see the volume confirm the execution of the pattern. And if I get both, if I get the execution with the volume, then I tend to rely a little bit more on my measurements.
Yeah, I was going to say, do you use the measurements to set your targets and your stops? I know I'm pretty much right on that. I generally do.
Yeah, I try to follow the measurements, but I tend to be pretty quick with the trigger finger usually. So if I get a stock that, maybe if a stock breaks out at, $100 and I've got a measurement that says it's going to go to 110, if it were to get up to 106, 107, something like that, to me, the reward to risk begins to start to potentially turn against you.
Right.
So and especially if that move up to 106, 107 in that example, if that were to occur, really quickly, then I would be much more apt to take that profit because it's hard to come up 6-7% profit in just a couple of days or a few days. So when I get them, a lot of times I'll just take them and move back into cash because at that point there is no risk.
Right. Exactly. Somebody did ask in the chat room about statistics that prove or disprove chart patterns work. Like I said, Thomas Bulkowski has done a lot of that for you. He's found that the high and tight flag is what he calls them, is the best pattern. But honestly, I mean, the percentages are pretty low that they actually execute to what they are supposed to execute to. I mean, I'm trying to think of where I might have some of those, but I'm trying to look up his yes, the pattern site. That's what it is called. Let's see, I pull that up, but you can go to his website, the pattern. Let's see. Like I said, I think it's pretty helpful if you can look that up. Let's see, why can't I find him? Oh, that's why. I'm spelling his name wrong. That yes, thepatternSite.com is a great place to go, but he has those percentages there. Let's see, I share the screen and I'll show you it real quick here. Okay, so yeah, thepatternSite.com. Again, I highly recommend his books that you can get that tell you about the Visual Guide to Chart Patterns is a great beginner book. And the Encyclopedia of Chart Patterns is what I use to look up those, kind of unusual chart patterns that maybe people don't know about that well. So anyway.
I think chart patterns too are so subjective, like you said earlier. What someone might view as a head and shoulder, I might look at and say, I really don't see it.
Right.
So trying to determine how often they work is kind of hard if you don't agree on the pattern existing to begin with. You know what I mean?
Right. Let's see. So. He does give you how to do that, and here is what you usually see. So 3/4 of the time you should see your price target hit. So you can look at it here to get more explanation and how it's worked out, what the rules are. But to me, he's the forerunner of all chart patterns. So, all right, I know we need to get into the 10 and 10. And of course, people, I've been talking this whole time. So I'm going to, as you start your first chart, Tom, I'm going to get all these others and start putting together a good list for you to look at.
All right, sounds good. Let's go ahead and take a look at the first one, which is PacWest Bancorp. First of all, it is in that banking space, which has been consolidating all year. So when you look at the chart, you shouldn't be too surprised. We have been consolidating. But I do think that the positive divergence that developed on the recent low, and, if you look at it again, we're using candlesticks, you might think, well, maybe we haven't gone to a new low yet. But remember, it's based on closing prices. This hollow candle closes at the top of this candle body. So the actual low close was at the end of June here at about $49.40. We definitely went to a lower close down here at 49. So that's what I'm connecting here. And the PPO is higher on that move. So I think we have a positive divergence here. I would look for where I've got the blue arrows. I'd be looking maybe for a 50-day test here and get that PPO back up to center line resistance. And then we'll see what happens from there. But in the short term, I think the move back up through the 20-day is a positive. I would expect to see maybe another $1.50 or so up to about 52.5, and then we'll go from there.
All righty, let's see here. What is the most popular in the chat room? Because that is going to be our second symbol, as I hurriedly write down all these other symbols that everybody has turned in. All right, I think that it was going to be, let's look. IWM is our winner right now.
All right. Well, IWM, I own it. So I'll just full disclosure there. I do like the pattern. I think it's a cup handle on the 20-day moving average. So I'm waiting for a breakout potentially. But there is the resistance. And I think if you use this parabola, you can see there is the high, here is the low, and here is the other high. There's your cup. Here is your handle back to the 20-day moving average. So breakout above 170. Like to see the volume pick up, but that would measure up probably about another $9 or so. So I'd be looking up around 178, 179 for a target, assuming we get that heavy volume breakout.
All righty. Let's do our next one, Disney, DIS.
Yeah, Disney has definitely improved quite a bit. So let's pull the chart up, take a look at it. The volume had picked back up again. Yeah, today I don't like today's candle, and I'm going to go back a little further and see if this is coming at a interesting resistance area. But the technicals clearly have improved. The volume's been strong. Yeah, see, now this is a problem, I think, in the short term for Disney. I would be a seller of Disney in the near term as a trader because we did break out above the January high on an intraday basis. As soon as this stock comes back down and goes below 112, I would be taking my profits and moving on, either waiting for the breakout to re-enter or maybe looking for a test back at the rising 20-day moving average. So I'm a little bit short-term bearish on Disney, but long-term bullish or intermediate-term bullish. I like the volume trends. I love this uptrend. You might even look at maybe 108. I mean, if I had gotten out, I might consider 108 to get back in. That was this recent high, and it would also be getting close to this rising 20-day moving average. So I think 106, 108 in that area is best entry now on the short-term basis into Disney, or if we do eventually get this breakout over, say, 112.25 or so. But now that we've got that false breakout, PPO looks good, so momentum is strong. I would be looking for only a temporary pullback. 106 to 108, I think, looks good.
All righty. And I don't think we've looked at this one in a while. How about Starbucks?
Wow. Well, Starbucks is just been under a lot of pressure. They have bounced back, but I don't like this failure at the 20. We'll see if we can get back through. We got through the 20 barely. Volume was picking up, so that was a good sign. Then we went right back below the 20. Now we're back up testing it again. I think we've got overhead resistance between 52 and 53, which I will show you using the auto support resistance line. That was a prior low. You can see multiple tests around $53 in terms of support. So that's a key support level. We went right through it on heavy volume. And then we had a little bit of support here around 452, maybe just below 52. And again, right through that level on very heavy volume. So as you move back up, not only are you trying to get through the 20-day moving average, but you got some really good overhead resistance at $52, $53. I would not be a buyer of Starbucks at this level from a trading perspective. I would wait. If we get a pullback closer to 48, I think you could have a positive divergence. I think that would be a great entry. Or maybe wait and see if you can get back up above 53 and what kind of volume accompanies that move. So for me, it's just patience here. I love Starbucks. I think it's a great brand name, great company. But at the same time, I don't like it technically at the price. So I would watch and see if I could get this one just a tad cheaper.
Okay. How about Square? That was also a popular request, and I don't think we have looked at that in a while.
Yeah, Square's been a great performer. I think I just talked about maybe it would consolidate for a while. It is up near the upper end of the range, but the volume's been light. So I'm going to just draw the range. I think this is what I drew last time. But right about 60 to 69 is what I would consider the trading range. We had a little bit of a sell-off at the latter part of June. Volume picked up a little. We've made our way back up on light volume to test the upper end of the range. If we do break out, you do want to at least know that you got a negative divergence in play. So if the breakout comes on light volume, or if you make the breakout and then reverse, have some sort of reversing candle, I think you better be careful because price support and that 50-day moving average both down in the low 60s.
All right, let's see. The next one I have is Coca-Cola, KO.
All right, I know sodas have been doing really strong. Soft drink index has been strong of late, getting another breakout on Coke. I think that the overall character of this chart has changed. We had a bottoming head and shoulder breakout that just draw the line, the neckline, so you can see that. But right about here over to here, to me, looks like a head and shoulder. Left shoulder, neckline, head, right side of the neckline, right shoulder on the 20-day moving average, which holds, and we break out. PPO now pointing higher, and we just broke out again above the recent resistance, 45. And then also there was a pretty good reaction high came in here at about 44.75. So this was a key area of resistance. The sellers kind of took over last week as we approached this area. But today, with volume already as heavy as it's been the last few days, and we've still got another 3 hours to go in the trading day, we're either breaking out or we're going to have a false breakout, one or the other. If we have a false breakout, leave that tail up there. I'd look for a pullback maybe to the 20-day. Otherwise, if we get the breakout, there's not a lot of resistance. I would say probably initial move is going to be up to about 46.5. But I do believe that Coke on a breakout above 45 is going to send it up to about 47.75 to test that January high.
All right, let's see. Let's try from the toy space, Glu Mobile, GLUU.
Yeah, this has been a great stock. We do have a negative divergence, but we're trying to get a reversing candle after just about testing that 50-day moving average. So the negative divergence is, again, higher price, which I think you can see pretty clearly here, with a lower PPO. Now, the good news here with GLUU is that on this breakout, which basically resulted in the negative divergence, look at the volume coming in. It's hard for me to argue negative or slowing momentum when a stock is breaking out on heavy volume. That just doesn't make sense to me. So, yeah, the lines might tell us it's slowing price momentum, but is it truly slowing momentum in the stock? I don't think so when you're getting heavy volume. So I think what I would be looking at is just the fact you've got really good price support. The breakout occurred above this early June high at 6. You got the 50-day moving average, which also essentially resets that PPO down near the center line. I think $6 is a great entry, with target being 675 or so to test the recent high, although I do expect that will break out in time. So the closer you can get this one to 6, earlier today it was 604, but the better I like it on a reward to risk basis. You could keep a tight stop at 6 if you want. I don't know that I would want to go all the way down to 550, but that would be the next support level.
All right, let's see. Diamond Offshore Drilling, DO.
All right, DO. Let's see. Got mixed signals here. Like the breakout just a few weeks ago, but it couldn't hold it. There was pretty good tops coming across there. I think you can see that right around $20, we had multiple areas. And by the way, look at that false breakout. That's what I'm talking about. When you get a false breakout, long tail above resistance, and it comes back down, Look what happened the next 3 or 4 days, right back to the 50-day moving average. If you spot this, stock was up near 20. 3, 4 days later, it's 17 and change. That's the difference. You got to be able to recognize these false breakouts. But anyway, we did make a breakout on heavy volume, but we came back down. And I think this gap support zone is really important here. I'm going to say, because that was the heavy volume gap up right here. So the bottom of gap support there is about 1910, 1920. And I'd like to see that continue to hold. So let's just say 50 days at 1931. I'm going to say any close below 19, and I would be careful with this. I would expect it to hold here, especially on that heavy volume gap up. I think that gap support should hold. I'd be looking for a return back up to 21.5.
All right. Let's see the next one. And if you have a chance, somebody asked how to set up those arrows and how they point to get them to point the right direction. BHC, Bausch Health Companies.
Yeah, this is Valiant Pharmaceutical. This was the name change I talked about yesterday. And I'll show you how you can do those arrows. But first, I would put in some price support because I think this one's got some pretty decent price support around that 22.25. You could even go down to the prior low, maybe 21.75, 21.5. But that's a key area of support that I would like to see hold. When you're doing these arrows, you just click on this arrow. I always, if it's a support, I always switch to it. I have kind of certain color codings in my head, but I like to use this green. And so if I just place it and just click, it will be on the side. See how I can kind of turn as I go around in circles using the mouse pad? It just depends on where you want to leave it. So here for me, I'm just going to drop it right there. And then the other thing, you can use the arrows on your keyboard. Once you can see that one's highlighted, it's got that yellow dot there. And I can move this thing just by using the keyboard. So if you don't get it exactly where you want to, you can kind of maneuver it a little bit like that. But anyway, this is the area I would watch for. So let's call it 21.50 to 22.25 support. And just remember, BHC is the old VRX, Valiant Pharma.
Okay. Let's see, the last one I have is going to be for our Canadian friends. And that is going to be, let's see, where is it? OSB.TO. That's forestry.
Okay, volume picked up a little bit yesterday as it came down and approached a low. 53 to 55 seems like consolidation since we pulled back. I'm going to shorten the chart here just so we can get a little bit better view. Let's just do the last 3 months. But off of this move to the upside, you can see this pullback. And once we pull back, the reaction high is that next high, which stops at 55. And today's candle, we'll see whether or not we finish like this. Now, this long tail to the upside, I'd be more concerned if it was over this top right here, because this is a much more significant top in my view. But there is a false breakout over this little trading range that we've been in. So perhaps we'll go back down to the bottom side of it, 53. But I'd be watching this trading range here between 53 and 55 pretty closely. If we break above 55, I think that could be pointing to a test up there around 58.5, 59, the early June high. But this failure, I would be looking for a pullback to 53. And if 53 doesn't hold on a close, then I think you can start looking a little bit lower. Maybe this little bit of congestion here down around 51 and then ultimately down 48.
All right, and that concludes the 10 in 10. And here you are with the symbols that we covered today. If you want to just go to the Market Watchers Live chart list, which you'll find at the top of the Market Watchers Live blog page, you'll find all of these annotations and symbols in there after the show. All right, well, we'll be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, now it's time for the final market update of the show. And very interesting market action right now. As you can see, most of the indexes did open lower. In fact, the S&P 500 and the NASDAQ both gapped down. But notice the meteoric rise, I would say, since that time. We've moved all the way back, took back all of those losses, and have now put on some pretty serious gains, with the S&P 500 up 1264 and the Dow is up 6884. We can see that we're breaking above previous overhead resistance that was formed back on Friday. So things are looking pretty healthy right now as far as the major indexes go. NASDAQ 100 also moving up. I suppose you could say we have a little mini flag here forming on both the NASDAQ and NASDAQ 100. Mid caps a little bit slower on the rise, but they are now starting to make new intraday highs. Neither the mid caps nor the small caps here on Russell 2000 opened that much lower. So they've spent a lot of the day moving up, but have started consolidating. Although with the mid caps, we can see a flag looks like it's executed as we are setting those new intraday highs. TSX is up, similar action with a big move down in the morning and then follow through as far as a rally. TNX, the treasury yields are unchanged, currently reading at 2.86. We see UUP, big gap up and a continuation to the upside, with gold following the exact opposite as expected. You have a big gap down for gold, has seemed to be finding its intraday lows right now, reading at about 116.17 for GLD. And we can see USO is up slightly, up 4 cents, currently 13.98 for USO, but really mostly unchanged. We are finally in the positive though for USO. And finally, the VIX is falling, and we're getting readings around 12, which shows that the market is feeling pretty good right now. And a lot of, I don't want to say complacency necessarily, but certainly a bullish flavor and feeling. And with that, I'm going to conclude our final market update and pass it back to you, Tom, to get started on our third and final segment.
All right. Yeah, we're going to take a look at correlation. I do want to just add on that volatility that you talked about. You know, that's one of the hallmarks of a bull market with the low volatility. The fact that the volatility has now gone back to that 12, 13 area, I think that's significant, because when you come out with bad news like Netflix had last night, the market tends to do a much better job taking that kind of news in stride than it does when we've got the VIX reading at 20, 30, 40, something like that, where anything bad comes out and the market just sells everything. So I'm not shocked by the recovery. I'm maybe a little bit shocked on Netflix recovering, but the overall market recovering, I think, is probably just another indication that we do have bull market conditions. But let's take a look at correlation and talk about correlation for a minute. I'm at the basically the homepage, member dashboard, and what you can do is click on the chart school if you're not familiar with correlation or any other technical analysis topic. And I just type in correlation and search, and a couple articles come up. The correlation coefficient, which I'll talk about in just a second, but here is just a very basic article on correlation. And so what is correlation? It literally measures the degree to which two or more variables move together. And that's what you want to take out of this article, really. So if two different variables have positive correlation, it means that they tend to move in the same direction. If they have negative correlation or inverse correlation, you'll hear sometimes, that means they move opposite one another. And we'll talk about different ways to use correlation in just a few minutes. But that is the basic definition of correlation. It's just the degree to which two or more variables move together. And I'm going to be concentrating on just two variables. Now, when you look at correlation coefficient, this is, you know, when you start looking at the correlation indicator on stock charts, you're going to see numbers that range from 0 in the middle to a +1 to the upside and a -1 to the downside. +1 tells you that the two variables, whatever you're comparing, are going hand in hand to the upside or to the downside. They're going together. If you have a -1 reading, then they're going exactly opposite one another. And if you have readings in between, or as you get closer to 0, there really is no correlation in either direction. So it's a little bit more random. Okay, now there's reasons why certain variables or certain asset classes, certain stocks correlate together with one another. For instance, if you're looking at industry groups, say the semiconductors, most of those semiconductors are going to have a high positive correlation with one another. As semiconductors go higher, many of those individual components will go higher. You hear a lot of times the market will say, this stock is up or down in sympathy with another stock. Well, it's because the two are highly correlated. So if one gets bad news, the other one tends to go along with it and go down with the one that had the bad news. Now, if you want to get into the calculation, and I usually like to figure out how these numbers are calculated, we're getting into square roots, and feel free to jump back in here and look at this anytime you want. I find it enough visually to look at two stocks and to look at their correlation factor or correlation coefficient, and I can generally see visually whether they're positively correlated or negatively correlated. And this coefficient is simply the number that confirms what I'm seeing. And it does track, it kind of tells you when things get out of whack in one direction or the other. And I'll point that out in just a minute. But again, if you want to come in here and look at how the correlation coefficient is calculated, here is an example. Feel free to jump right in. But I would suggest, even if you ignore the calculation, I think it's a good article just to go back and take a look at and understand correlation and how you can interpret these readings here at StockCharts. Okay, so let's go on and move on to, I want to show you one other thing you may or may not be aware of with correlation. But if you go down to your chart list, and by the way, if you're at the top of this page, you see these little gears over here. If you click on that, make sure you have chart list panels checked. If you don't, then your chart lists are not going to show up at the bottom. So make sure you have that checked, update, and then when you go to the bottom, here are all the chart lists that I have in this particular account. Now, I've got strong earnings. This is an old strong earnings chart list, but I'm going to use it as an example. It's probably from 1 or 2 quarters ago. But let's pull this one up and take a look. See all these different ways I can view my chart list. One of them is correlation. So if I pull that up, it's going to take a look at every stock that I have in this list and show the correlation. And remember, +1 means that it's almost perfectly correlated to the benchmark. And in this case, the benchmark is the S&P 500. And if you go down to the bottom, whichever the lowest reading is, tells you that it's negatively correlated. Well, it could be negatively correlated, not because it always moves opposite the S&P 500. It may just have come out with a recent bad report. And so the S&P might be moving in one direction, and Gap, for instance, could be moving in another direction. Or Gap could be going up while the S&P is not doing anything or going lower. And that would give you your negative correlation. So don't assume just because you have negative readings that you're always going to have a negative correlation. This is strictly looking at a look-back period of 20 days. If I change this and I look at 6 months, all of these numbers are going to change. So make sure you kind of do a little homework before you just jump to a conclusion that a certain stock is going to automatically go along with the S&P 500. And you can change these benchmarks. I could throw in here the dollar and say, okay, over the last 6 months, how do the stocks in this list correlate to the US dollar? Well, the dollar over the last 6 months has been going mostly higher. We did have a pullback, but if you look back over, back when we bottomed in January, we're higher. So if you've got a stock that you're looking at that's higher, you're probably going to have positive correlation. Now, these strong earnings, because most of these companies probably have continued to do well, you're going to see many of them have a positive correlation with the dollar. That doesn't mean that they'll always go up with the dollar or down with the dollar. It just means for the last 6 months, they've both been moving in the same direction. So don't overread or come to conclusions that maybe aren't sound. You want to be careful about that. But still, if you have a portfolio of stocks and you want to see how they correlate with the S&P 500 over different time frames, this is a great way to do it. To take one quick glimpse at which ones are performing better, which ones are performing worse. And if you have a chart list of small cap companies, you might change this to either the Russell 2000 or maybe the S&P 600 small cap index. And then click your go, and then you can see how they correlate with that particular index. Okay, I do want to go over a couple of charts. So let's take a look first at Freeport-McMoRan, FCX, and compare the correlation, determine the correlation with copper prices. Freeport-McMoRan has, connections. They do a lot of their business in copper and gold, mostly in copper. So I would expect that there's going to be a positive correlation. And if you look at the correlation, this goes back to the beginning of the century. So we're talking about going back the last couple of decades. And if you look, almost all the readings on these weekly charts are above zero. Occasionally we go below zero, and that could set up opportunities. If you know that two variables or two asset classes, or in this case, FCX and copper, if you know that they're generally highly positively correlated, and all of a sudden you have a negative correlation, that could be setting up an opportunity in one or the other. So you want to look at the charts and see which one seems more likely from a technical perspective. And whether, like here, copper prices are going down. It looked like maybe here FCX was trying to make a breakout and move higher. That resulted in a negative correlation. Well, that move in FCX didn't last. Copper prices kept moving lower, and then FCX tumbled as a result. Here we can see copper prices have really dropped down at least to a key price support level. But if they keep dropping, chances are FCX is not going to hold 15 support. So this is one positive correlation that's worth keeping an eye on. Next up on this one, I talk about this all the time, evaluating the market and the dollar. But this is simply a chart showing the U.S. Treasury yield, the 10-year U.S. Treasury yield, minus Germany's 10-year Treasury yield. As it moves higher, normally we see the dollar move higher. Here's your correlation showing over the last decade how we remain almost always above zero. The three lowest levels, the inverse correlation, set up an opportunity. Here you can see rates rising in the U.S. versus Germany in all of these shaded areas. And in these shaded areas, the dollar was going opposite. And so that's what resulted in these rare negative or inverse correlations that developed. And I remember talking about this back in March when we first saw this, highlighted it, and we were at key relative support on the Russell 2000. Normally what happens coming out of these periods, or what has happened the last two times, huge moves up in the dollar to reestablish that positive correlation. And I think we're on the verge of doing it again. We're hesitating a little bit at neckline resistance at 95. But if the dollar breaks out above 95, I think that is going, I'm looking for it to break out because I think it's going to follow suit with the 10-year Treasury yield here in the U.S. versus Germany. That continues to rise. I look for the dollar to break out and for this positive correlation to continue. And then if that's the case, then we should continue to see strong relative performance out of small caps. Now, one other thing that a dollar breakout would do is dollar and gold have an inverse correlation. We've been talking about positive correlations. Take a look at this inverse correlation. This goes back 2 decades, and you can see the price of gold here at the top, the U.S. dollar index at the bottom, and here is the correlation with almost always, for the most part, we remain in negative territory, suggesting that the dollar and gold prices move in opposite directions one another. So if I'm right about the dollar moving higher, I don't want to be in gold. Gold is starting to turn back down. And even over the last 2 years, you look at it and you say, well, gold's been going up. Well, it's been going up, but it's been going up at a much slower pace than the S&P 500. So on a relative basis, gold has actually been an underperformer. I'll just go ahead and put this in here. And let's take a look at gold versus the S&P 500. And so gold's been going up the last 2 years, but look what it's been doing relative to the S&P 500. It's been going down. And so as long as the dollar is on the rise, I would suspect you're going to see relative weakness on gold prices. Okay, so let's summarize quickly what we have here, and then we'll wrap up today's show. We did have an explanation. I talked about the definition. You can always go back to chart school anytime, not just correlation. Anytime you have a question, technical analysis, go back in and type into that search box at chart school, and you're likely to find some great articles. Arthur has done a tremendous job There are others as well, but I know Arthur spent a lot of time putting together that chart school, and it is fantastic. So check that out if you have questions. Also, the chart lists. I think I showed you how you can kind of use the correlation indicator in your chart list, and then went through a couple of different examples of positive correlations and one negative correlation. So hopefully that helped you understand correlation and that indicator a little bit better in stock charts. Okay, Erin, well, we've got another trading day here, almost, well, not trading day, but a show complete. We still got 2.5 hours left in the trading day, but this is a big reversal in the market.
Absolutely. And clearly Netflix was, I'm thinking, was part of the reason we saw that decline, with just everybody was shook up by that particular piece of news. But yeah, I think everybody else is probably licking their chops at Netflix as well. And some of them are already getting back in. So I think it's pretty interesting. But now, yes, the market is heading straight up.
Yeah, I'm going to go ahead and flip over and take a look at that Netflix chart, because there is a possibility of we may have just hit a key resistance level where it'd be interesting to see whether or not Netflix continues rising, or if maybe we're going to see a reversal. Here's the chart, and I'm going to annotate this because we had support, just TA 101 when you've got price support, which had been holding here close to this 380. If I used an intraday, I could use 380. That's where you got these tails. But I generally like to use candle bodies. So I'm going to go up to about that 383 level. Today's high was 385. We're now at 381. After gapping down below this price support, that then becomes price resistance. A lot of volume coming into Netflix. I think this is, overall has been a positive day, unless the bottom falls out in the next 2.5 hours. But I would watch 383, 385, this level, because if we start to sell off, this could have been only an initial bounce and reaction, and we may work our way back down one more time toward that 350 level. Netflix is going to be interesting. I did see, though, Roku is making a breakout kind of in that same space. Roku is having a great day. Unfortunately, I got out and waiting for a pullback that just isn't coming. But I do think Roku has some overhead resistance here at 52. But a good day for sure.
Yeah, I mean, if you look at that 340 level, that it practically made it down to Netflix, it's right on those two tops from March and April. I mean, this is perfect area for support. I'm watching my PMO. It's pretty much in free fall on the downside, mainly because of trading this last week. But I'm going to be watching that and see if I can see a change in that momentum happening. So
yeah, 340 is that price support level that you alluded to there, and then also the rising 20-day moving average sitting at 346. So.
Exactly.
Okay, well, another great show. Yes. Certainly really good chart pattern 2.0 workshop.
Thank you.
Very, very well done. And what else we got? Anything before we wrap up?
Well, just our upcoming schedule. We got Tom McClellan tomorrow. That's going to be pretty exciting. And Julius will join us Thursday. And Friday, we should get some very interesting tips and tricks during the Everything Stock Charts segment. But for now, I'm going to tell you goodbye and our audience goodbye.
Yep. And I will be back tomorrow, but I will be out on Thursday and Friday. So you'll have Julius on Thursday. And then, of course, Chip coming in for Everything Stock Charts on Friday. So still a great end of the week for sure. Looking forward to having Tom McClellan back in tomorrow. He's given us some interesting predictions in the past. I'm curious to see where he stands as we head into August.
Absolutely.
All right. I want to thank everybody for being with us today. Please complete that survey as you exit, if you don't mind. We'd love to get your feedback, hear what you think of Market Watchers Live, and what you thought of the chart patterns that Erin went over today. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here on Wednesday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.